Welcome, everybody, to our Parent Information Night. Tonight, we are offering you guys an amazing opportunity to attend a free financial literacy parent workshop for first-time home buyers. So this is being sponsored by Widener University. We have a teacher, actually a social worker from Stonehurst Hills Elementary School, Zach Casabo. He's actually on the phone on the call right now. He is responsible for setting up this amazing partnership with Widener and is bringing in all this content to our families and our communities, and we deeply appreciate it. So one of the things we want to do is just focus on something practical when it comes to building wealth for families. And we know that owning homes and owning property is a big way to do that in our society. So we have some experts with us tonight. We have Sarah Gachal. Can you please introduce yourself? And if I mispronounced your name, I apologize.
That's okay. Hi, everyone. I'm Sarah Getchell. Ann and I work together in her real estate office, and I've been a mortgage broker for about 8 years now. And prior to that, I was a teacher. And prior to that, I got a literature degree as well. So I kind of fell into mortgages through friends and family, and I just love it. So thank you so much for joining us.
Thank you. Thank you for facilitating this for us. And Ann Hanna?
Hi, I am Ann Hanna. I am a real estate agent. I work with Keller Williams, and I'm on the Matt Feddick team. We're a sub-team of Keller Williams. I'm also an attorney, and I've worked at Widener as a professor, which is how my connection to Widener. So we're happy you're here tonight.
Yay. Thank you, parents, for coming. We have about, minus us and Zach and Andrew, who also works for the district, we have 16 people here. We, as usual, and I'm going to keep saying this, we need more parents out here. We need more of you telling people that these resources are here. The virtual parent information nights make it so possible for people to participate, to put on some earbuds wherever you are driving, to turn it on and just participate. So please, please, please tell your colleagues, your parents, your neighbors. We need more participation. We only have 16 people here. Okay, so I forgot to tell you who I am. My name is Aronda Buford. I'm the Director of Communications for our amazing school district, Upper Darby School District. And on behalf of our superintendent, Dr. Dan McGarry, and our school board of directors, we are pleased to present this topic for you tonight. And without further ado, I'm going to turn it over to our lovely ladies.
Hello, everyone. Welcome. We're so happy you're able to join us for the home buying seminar tonight. We've already introduced ourselves. I'm the real estate agent. Sarah's the mortgage broker. So we're going to split up some of these slides according to our expertise. So we're going to cover a number of things today, and we're going to go through each of them. We're going to talk about the benefits of owning a house versus renting. We're going to talk about the home buying process sort of overall. We're also going to talk about all the steps that are involved in it, including mortgage pre-approval, which in my opinion is the scariest part for a lot of people. And then all the steps from that point all the way to actually owning your house. Is the next slide coming up?
Yeah, it should be there. Yeah.
There it is. Okay. So first of all, let's talk about the benefits of owning a home. I think a lot of people who are thinking of buying a home, their first thought is, oh, home owning is so expensive. It's too expensive. But it actually, if you look at it, it can cost less than buying a house, especially when the rents keep going up higher and higher. You look at what you're putting into it, and more importantly, what you're getting out of those costs. The biggest benefit of owning a home is you increase your wealth through an increase in the equity of your house. As you pay off your mortgage, you own more and more of your house. And as house prices go up in the area, your home is worth more money than you bought it for. That increases the value of your house and your wealth as well. So those are things that you don't get when you rent. Another factor, and I'm not a tax expert, is but there are certain deductions you can take when you're a homeowner that you cannot take as a renter. So that helps in terms of offsetting some of those costs of just having a place to live. Another aspect is that people who own homes tend to be more involved in their community. They have more of an ownership interest. They're all in terms of making sure their yard looks nice and their house on the outside looks nice, and they're involved in things that are happening in the community, which is a positive thing all the way around. And the last thing, and this is something that my younger homeowners really look at, is when you own your house, you can change it. You can make it your own. You can paint it. You can move walls. You can make additions. You can do all sorts of things. And you're not able to do that when you rent. You sort of have to live with the home as it is. As a homeowner, you literally get to own it. Next slide. There we go. Okay, so let's break down why renting is actually more expensive. The number one reason is when you pay your rent, that money goes to your landlord and that increases your landlord's wealth. That doesn't increase your wealth. Whereas if you own it, you're paying off your mortgage or you're owning it over a period of time, that increases your overall wealth in the house. You don't realize that wealth, you don't get it until you sell the house, but at least you get that increased wealth in the end. When you rent, your rent tends to go up. I don't think rent ever goes down. So your monthly rent goes up sometimes at the end of your lease agreement, usually not during your lease agreement. But if you own a house, your mortgage payments, if you have a mortgage, are locked in. You pay the same rate unless you have a specific kind of mortgage that has what we call an ARM that will change. Other than that, it stays the same throughout. We also talked about, the fact that when you own a house, you can customize it, but when you rent, you can't. You can't paint. Sometimes you can't even put up like nails and things with nails. So you're kind of limited sometimes in what you can do when you rent. When you rent, you pay not only rent fee, sometimes you have to pay rent. If you own a pet, you have to pay extra rent for them. You have to pay a security deposit. You have to pay your last month's rent. There's a lot of costs involved in renting that you don't have when you own a house. You can have as many pets as you want. You have to pay for them, but you don't have to pay an extra fee. The expense that you would have in owning versus renting in terms of an upfront cost when you buy a house is your down payment. And some people are scared of how much that would be. And Sarah's going to talk a little bit about the fact that sometimes down payments are less than you think they are. So that it's a little bit more affordable. Next slide. There we go.
All right. So I have a chart here. You know, the interest rates have been in the news a lot lately because we've seen pretty much the fastest climb in interest rates over the last couple of months that we've seen historically. But I really think it's important to know, even though rates right now are they're around in the low 5% right now for the rates, the high 4s for some of our government type of loans. They're still, as far as historically speaking and what interest rates have been in the past, we're still at historically low interest rates. So even though we are starting to creep into the 5s, still over time, you know, when my parents bought a house, they spent $80,000 to buy a house, but their interest rate was 18%. So, you know, historically speaking, we are still low. So this graph here kind of just shows you a little bit of what's been going on since December. So this is the last 6 months, and it just shows you an overview of what interest rates have done over these last 6 months. So you can see we were still pretty steady here back in December. At that time, rates were hanging around 3.75, 3.5, 3.75. So since then, up until now, you can see in the last couple of months from March to May, we've seen this really steep increase in rates. We are going to talk about the market that's coming, toward the end of our presentation. But you know, what this means for home buyers now versus a few months ago is, you know, the same house that you maybe qualified for a couple of months ago, you may not qualify for now or moving forward if rates continue to rise. And so it really illustrates that, you know, sometimes, you know, a lot of people think you need to save up 20% down to be able to be ready to buy a house. But if you're spending that time saving to buy the house and waiting until you have the 20% down, it also means that if you wait too long, your payment might increase if you wait for the rates are going up. Inflation has been crazy lately as well. So the home prices are getting higher and the interest rates are getting higher the longer that you wait. And we do have some slides about that as well. And then, also the longer you wait, the less equity that you're going to have built over that time that you're waiting. Now, for some people, I really take an advisory role as far as everybody's situation is different. My goal is to listen to what your goals are, and really try to guide you in the best way. For some people, they need that time to build their credit, to do a little bit of saving. And so part of what we do is make sure we're getting you on the right path so that you at least know what those figures look like and are setting a goal and a path for yourself of how to get to that goal of home ownership. All right. So this is really just an example chart showing how your buying power can change based on interest rates, right? So over here, this rate chart is almost exactly what I was talking about, between 3.75 and 5.25 here with the interest rates here. So you can see here's the different purchase prices of the houses. So down at the bottom is a $500,000 house at 3.75, which has a payment of $23.16 a month, right? So as the rates have increased up to 5.25, that's now a $450,000 house versus a $500,000 house. So this is an example over the last 6 months of just what we've seen with the rate increases. And I'm going to again talk about what we're projecting to happen over the next, year or so, but to be honest with you, I follow the market as closely as I can. There's the stock market and the bond market, and the mortgage interest rates follow the bond market. So typically when the stocks are not doing well, mortgage rates actually tend to do a little bit better and get a little bit lower. So it's kind of like a seesaw with the stock market and the bond market. And so just like the stock market with the bond market, we don't really know. We don't have a crystal ball to know exactly what's going to happen. The best that we can do is look at history and the trends in history and what has happened to be able to try to tell you a projection of what's going to go, what may happen going forward based on what we've seen historically. So we try, but there's no guarantees that we're going to, know exactly what's happening coming your way.
Okay, so let's talk about the steps to buying a home. We're going to talk about each of these on a separate slide. Preparing to buy a home, getting pre-approved, finding a home, going to close, and then actually closing on your house. So the first step is preparing to buy a home. This is more of a, are you ready to buy a house? So we typically say that people are ready to buy a house if a couple major events have happened, or if a major event has happened in your life. Things like, are you getting married or moving in with a partner? Sometimes like, hey, instead of renting another place, let's buy a place. Or if you're having a baby or a family member is moving into your house, maybe you suddenly need more room in your house. Or if you've your job has shifted to more online and you're working from home either more often or permanently, you now need to get a designated or a dedicated office in your house rather than working at the dining room table. So sometimes, or if you got a new job and you have more money to spend on a home, those are things that usually trigger it's time to buy a house. So that's the first question is, why are you ready? And then we're going to talk about steps. Once you got to that point, you're like, yeah, I need to buy a house. This is why. The first step is finding a budget. Figure out how much you want to spend on your monthly housing costs. That will include your mortgage, but it also includes some other things like taxes and insurance and mortgage insurance. Those things also have to be factored in, but like, what's that total number for you? And we will help you figure out what kind of houses price point you can afford based on that number. What's your timeline? When do you want this move to happen? And sometimes that's based on the why you want to move, why you want to buy a house rather. what is that event that's happening? I've had clients who are getting married and want to buy a house before they get married. That's kind of their trigger. So know your timeline. That'll make a difference in terms of how we approach it. You need to have a list of wants versus needs. So needs are things that you absolutely have to have in that house. That house is not going to fit you if it doesn't have these characteristics. Wants are a little bit trickier. These are things that you would like, but the question is, can you live without them? So understanding the difference between your needs and your wants is really important before you start the housing process, because it makes it harder to buy the more things on your list that you're putting in the needs, even though they're really wants. The last point on the slide is you need at least two people to help you buy a house. You really do. You need a realtor and you need a mortgage professional. Those two people, the earlier you get those people on your team and helping you with this process, it's going to make it easier in the end. And the next stage is pre-approval, which is Sarah's area of expertise.
Yes. So, especially my first time home buyers, I go through the process of pre-approval and ultimately mortgage approval every time I talk to them from the beginning. So this is what I always talk about. There are three areas: your credit, your income, and your assets, right? And we're really looking at a 2-year history of these three things. So with the credit, your credit score is going to drive your interest rate, just like when you buy a car. Not only with the credit score driving your interest rate, it's also going to drive your mortgage insurance. So, and I forget if there's another slide about mortgage insurance, but mortgage insurance, every time you put less than 20% down, you're subject to paying mortgage insurance. The amount that you pay for mortgage insurance is tiered based on how much you're putting down and your credit score. So if you're putting 3% down and you have a credit score in the low 600s, you're going to pay more in mortgage insurance than someone with a 740 credit score who's putting 10 or 15% down. So that's what mortgage insurance is, and that's based also on your interest rate. With the income, that is really the income and your debts is how we determine how high you can go in purchase price. So what we look at is we're going to be asking about 2 years of your work history. Where do you work? How long have you worked there? How are you paid? These are the important questions, because there are different rules about how we have to calculate your income based on how you are paid. So if you are self-employed, it's a 2-year history, and we average the last 2 years. If you are an hourly employee, we calculate that. If you're a salaried employee, we calculate that. So really, ultimately, what we're getting at is your monthly gross income divided by your monthly debts that we see on your credit report when we pull that. And then we add in whatever the potential housing payment is with those debts. So it's your income divided by your debt. And then that number gives us our debt to income ratio, or your DTI. And so with the DTI, typically we get an approval under 50%. So that may even be, of course, I would be glad to help you with that. But if you're trying to figure it out in your mind on your own, it's what do I bring in monthly, divide it by your debts, your monthly debts, and then add in, if you want your payment to be $1,300 a month, add that with your debts. And that number needs to be under 50%. And that's really, what you would qualify for. So with the debt to income ratio, as you can imagine, the income sometimes fluctuates. If you have bonus income or overtime or commissioned income, that may change your qualification. If you, let's say you want a $350,000 house, but I'm telling you, without doing anything, you're qualifying at 300. We can also look at your debts and say, okay, are there any debts here that we might be able to have you pay off so that we can get your debt to income ratio in line? Right? Is there anyone we can add to loan? So that debt to income ratio is very, very important in determining how much you qualify to borrow, and ultimately the purchase price that you qualify for. And then the assets piece, I always talk to every single buyer about this. There are rules. There's a lot of rules regarding the mortgage business and how we determine what you qualify for the loan. And one of the rules is for assets being used to buy a house, we have to have a paper trail for everything. So we have to be able to document what funds you're using for the home purchase. So now you can get gift funds. So again, there are rules about gift funds. So if mom and dad are giving you $10,000, if you're lucky to have a mom and dad that will do that, that's absolutely fine. It does have to be a family member or someone that has ownership interest in the property. So those are kind of important rules to keep in mind about who can give you a gift. And when we talk about assets, we're going to ask for 2 months of your most recent bank statements to show the funds that you plan to use for down payment and closing costs. When we get your bank statements, the 2 months of your bank statements, we're going to look to see if there are any large deposits on there. We don't care what you're spending your money on, what's going out. We do care what's coming in because those rules are in place to deter money laundering and stuff like that. So when we get your bank statement, if there's a $4,000 deposit in cash, we're going to say, okay, what is this and where did it come from? And we need to then see a documentation of where those funds came from. I talk about it always right in the beginning because I've heard a lot of things and seen a lot of things of where people get money from. So, if you have a side business or side jobs, or you get cash for you sold your car and you got a cash for selling your car, all of these types of things you sell on Etsy, you work under the table doing X, Y, and Z, whatever the case may be, where cash is coming in, you let somebody borrow money and now they're paying you back for that. If we see that on your bank statement, then those are funds that we would not be able to use for the purchase of the house. So what I tell my clients that have that stuff going on is put that money, that cash money, in a separate bank account, and use that for your groceries, your gas, your rent payments, whatever you might use that for. And then your payroll checks that we actually have a paper trail for, use that for saving for the house, or use that bank account for saving for your house. It just makes life so much easier if you have those separated, or if you have that cash allocated toward other things that aren't the house, if that makes sense. So that's kind of the 3 areas that we look at. And that's not just for pre-approval, but ultimately for your actual mortgage approval when you find the right house. And we get into that process. All right. And how much do you need to buy a house? So there are different types of loan programs and different down payment amounts, depending on what type of loan you end up with. These 4 types of loans, there are many other types of loans, but these 4 types of loans, I would say about 98% of people fall into one of these categories as far as these different types of loans. So a conventional loan, a lot of people think you have to have 20% to put down. You do not. You actually can put, if you're a first-time home buyer, as little as 3% down with a conventional loan. Now, part of what I do is show you all of the loan options that would be available for you. And then, together we'll determine which loan product fits you the best as far as what's going to work the best for you. Typically most people are like, I want the one with the lowest payment and the lowest amount of cash to close. Right. So that's what would help you figure out. So there's the conventional loan, as little as 3% down. The FHA loan, which is the other 3 loans, the FHA, VA, and USD are all government loans. FHA allows for 3.5% down. Now, there are benefits to FHA versus conventional and vice versa, depending on your credit score. Depending on, a lot of it does depend on credit score. So FHA is a little more forgiving with the credit score. You're going to get it, if let's say your credit score is maybe in the 600s or up to, I'd say 660, 670, likely the FHA loan is going to be the best option for you. There's reasons for that. The interest rates are a little bit better for conventional loans. And the mortgage insurance rate for FHA is a set amount. It's 0.85%, no matter what your credit score is. And no matter how much you're putting down, it's always the same. With conventional, like I was saying, it's tiered based on that, your credit score and how much you're putting down. So if you do have a credit score that's, in maybe the mid 600s, you're going to pay less in mortgage insurance with the FHA loan than you would pay with a conventional loan. And so, again, part of what I would do is show you those options side by side and talk you through why that is, right? Now, the downside of FHA is With the mortgage insurance, you cannot get rid of the mortgage insurance unless you sell or refinance the house. With a conventional loan, you can drop that mortgage insurance once you reach 20% equity in your house. So you can apply then to have the mortgage insurance drops. With the mortgage insurance, sometimes can be a couple $100s a month. So what you would do at that point is, call the mortgage company, say, I think I have 20% equity and I want to apply to have my mortgage insurance dropped. Now, it is also important to think about, okay, this is my first house. It takes a long time to get from 3% equity to 20% equity. So it might take you 10 to 12 to 15 years to get to the 20% equity. You might be in another house by the time the FHA, it even comes to that point, right? So, if you're saving a couple $100s a month, typically it's going to be better to just go FHA. And then when that time comes and you reach the 20% equity, you're either going to be ready to move or you're going to be at a point where you're ready to refinance anyway. Then we have the VA. The VA loan is only for veterans, veteran or veteran and spouse. It is 0% down. If you were in the military or, your spouse was in the military, I have compared FHA with other types of loans many, many, many times. If you are a veteran, the VA loan is the way to go. You save a lot of money. The interest rate is better. There is no mortgage insurance. The rules for student loans is more lenient for the veterans. They have, the VA has people that look at your loan file that are, pulling for you within the VA. So it's easier to get an appraisal dispute done. So there's just a lot of benefits for using your VA benefit loans, for that, if you fall into that category. And then USDA is another government type of loan. It is a 0% down, but it's only in rural areas. So, within Upper Darby and the surrounding areas, there aren't going to be any homes that really qualify for USDA. It's going to be more, more on the outskirts of, where our office is in Kennett Square. There are areas of Kennett Square where the farmland is out there where there might be USDA available. Down payment assistance. So there are down payment assistance programs that are out there. I will help navigate that with you as well, if you qualify. So down payment assistance programs are out there, specifically in Delaware County. I know they have, they do have a program that offers up to $5,000 of down payment assistance. You have to qualify for the down payment assistance. So you have to have a certain credit score. There are income limit requirements. So you can't make more than a certain amount of money. Your household can't make more than a certain amount of money. The reason for that is because those programs are in place for low to moderate income households. So they want to make sure that those benefits are being used for the households that really truly need it, that are low to moderate income. And then the more people that are in your house, the more that income level increases. But again, that's more on a case by case basis, and I'll help, I could help you navigate that. Okay, closing costs. So you have your down payment. So I was saying 3%, 3.5% down would be the minimum for FHA and conventional. In addition to that down payment, and this is honestly, it is the biggest shock factor for first-time home buyers, is the fact that on top of that down payment, you also have closing costs. So closing costs for the house is you're going to pay, I always like to break it down into a couple categories, but you're going to pay finance charges. Typically, at least for my lenders, it ranges between $1,000 and $1,800 for the finance charges. Then that includes appraisal and the underwriting fee. And then you're going to have legal fees. So in Pennsylvania, you'll have a title company that's going to help you with doing getting title insurance, doing a search on the property to make sure there are no liens and you can own the property free and clear. They're going to facilitate the settlement. They're going to notarize everything for you. They're going to be there to disperse the funds at settlement. So they have fees for the work that they do. And then you're also going to have government charges. So, you're going to pay transfer tax. In Upper Darby, it's 1.5% of the purchase price that the buyer pays, and then 1.5% of the purchase price that the seller pays. And so together, that 3%, it makes up the transfer tax, and that money goes right to the government. Unfortunately, there's no getting around that. And then you're going to have your escrows. So what escrows are is your property taxes and home insurance. You pay those. We collect some at settlement to put into an account that the mortgage company is then going to pay out your property taxes and home insurance for you. So you never have to worry about paying that. But we have to set up an account at settlement so that there's enough money in there when those tax bills come due and your insurance bill comes due to be able to pay those bills when they're due. And so we have to collect that property tax and home insurance at settlement as well. So that's a part of your closing costs. And then also when you settle, you're going to reimburse the seller of the house for any taxes that they've already paid for the year when you're living in the house. So you have to pay them back some money too for the taxes that they've already paid for the year, or sewer or trash or whatever, they've already paid for that year. So that's what goes into the closing costs. And the closing costs, they can be, anywhere between $8,000 and $20,000, just depending on where you're living, what the house is that we're looking at, because the property taxes are going to fluctuate depending on what house you choose. So when I do estimates, my whole goal is that there are no surprises when it comes to that stuff. So, there are a lot of lenders out there, and it's just something to kind of be aware of as you're shopping and as you're talking to people about that, especially the online lenders. They're not going to tell you all the fees. They're going to say, our fees are X, and then you're going to be 2 weeks from settlement. And then they're going to say, oh no, it's $5,000 higher than what I told you. And so that happens a lot. What I would say is, ask those questions, ask as many questions as you possibly can. For myself, what I choose to do is be on the conservative side and overestimate what we think those closing costs are going to be, so that when we get to settlement, I'm like, yay, it's $1,000 or $2,000 less than what I told you, as opposed to the other way around. So, that is important to me. When we're talking about your money and your financials, there should not be any surprises, along the way, as far as what you're paying for, based on what the estimates were that you received. And then there are ways that you can get closing cost assistance. There's something called seller assist. I'm not going to get into that too much tonight. I could talk forever, but you can get the seller to agree to pay a portion of your closing costs for you. It is tough in the market that we're in right now, just because the sellers kind of have the upper hand in the market. And so they're not crazy about doing a seller assist right now. Usually if seller assist is happening, it's because there's something going on with the house where they're giving a credit, or, some extenuating circumstances that seller assist is in the picture, but we're not really seeing it a lot right now. A lender credit is also something that could help you with closing costs. And what that is, that has to do with interest rates. So I would present you with interest rate options. Here's a 5% interest rate. Here's 4.875. Here's 4.75. Once you get to that point in the process, you have a choice whether you'd like to buy down your interest rate, which means you can pay a one-time fee as part of your settlement to get a lower interest rate, or you can take a lender credit, which is taking a slightly higher interest rate. Maybe you take a 5.25% interest rate and you get $2,000 to $3,000 to help you with your settlement costs. So usually a lender credit, just because of the long term, you want as low of an interest rate as you can get. So usually the lender credit, where it is helpful, is you found the perfect house and you're $2,000 or $3,000 short on the funds you need for settlement. Then you're like, okay, if we have to do the lender credit, I'm okay with taking a little bit of a higher rate to be able to get the house that I want and save $2,000. And that's something we would talk about once you're a little bit further in the process. But that option is there. Okay, what goes into your mortgage payment? So this is everything that goes into your payment: your principal on the loan, your interest, your property taxes, your home insurance, and your mortgage insurance. So this does talk a little bit about what are those things. Your property taxes, we're going to look that up for you. The interest is the charge. It's what you're paying on the loan, the interest on the loan. And it is amortized just like student loans would be, where you pay mostly interest in the beginning. And then the principal kind of flip flops as the further that you get throughout the loan, even though your payment is going to stay the same. The only thing that can change your payment, your mortgage payment, is if your property taxes increase or your home insurance increases. The principal and interest are going to always stay the same. The mortgage insurance is going to stay the same until you're at the point where you can drop it. But the property taxes and home insurance, might creep up on you. Usually they don't go down. So, that might creep up on you every couple of years and add a little bit to your payment. Right. Okay, I did talk about mortgage insurance. VA does not have mortgage insurance, and the other one can be removed. All right, Anne's up. She's going to talk about, finding the house, which is the fun part. I do not have the fun part and talking about the money. Anne gets the fun part.
Yeah, that's the important part. And one thing I forgot to mention is that you should find a real estate agent and a mortgage broker who fit you, who listen to you, who connect with you. To find those people to be part of your team in finding a house, you need to find people who really are on the same page as you. So yeah, my job, finding the house, this is the fun part. So when you meet with your real estate agent, they will talk to you about what kind of house is going to fit you and where you are and what you need. We're going to talk about things like the areas. There's a lot of different areas in the greater Philadelphia region. And we also have the New Jersey, Delaware options because we're so close to those state lines. So not all agents can sell real estate in all of those markets. So finding out what works for you. Sometimes it turns on, particular school district that you want to be in, or how far of a commute you want from your job. So those are all attributes that you need to consider when you're looking for a house. We're also going to talk to you about how big of a house you want, how many bedrooms, how many bathrooms, what square footage. I find that some people have an idea of what they want. And once we start looking, some of the things they want change in terms of like, I can probably live without a fireplace now that I see that there's only so many houses that have a fireplace, or whatever that attribute is. I call it kissing frogs. You have to get out and actually look at houses, look at a lot of pictures, and literally go into houses and get a feel for them before you get an idea of what's going to fit you. So we got to kiss a lot of frogs before we find a prince of a house. So the first thing your agent's going to do is have a conversation with you about what you need and what you want. The needs are really important. The wants are kind of secondary. And they will set up an automatic search for you. So houses that are on the market in the areas that you want to consider that meet your criterion will come directly to your email, however often you want. If it's every day, if it's right away, however you want. And then you can sort of go through those. I know you can do that on realtor.com and on Zillow and some of those other online places. So you have access to the same houses that are on the market, but what realtors can connect you with are houses that are coming soon on the market. They're not there yet. So you sometimes get a little bit of a preview of houses that are, maybe they're listed today as a coming soon, but you can't see them until Friday. So that kind of helps a little bit to get it through your realtor. But again, you have access to it. The public has access to those other ones. But sometimes those systems aren't updated, whereas the MLS system, multiple listing service that realtors use that we will send you notification from, are updated literally every 2 minutes. So they're completely updated, whereas Zillow and realtor.com, a lot of my clients will tell me they find a house on realtor.com and I look it up and say it's already under contract. Anyway, we'll send you the emails and then you look through those pictures and the information online and say, hey, I want to see this house. Then you make an appointment with your realtor, who makes an appointment with the owner of the house, and you get to go see the house, and eventually you'll find one you like. Sometimes it takes a little while. Sometimes it takes 1 or 2 houses, and sometimes it takes 100 houses. So it just all depends. Next slide. So one of the options that homeowners have is the question of, are we going to buy an existing house or are we going to buy a house that we can build? Obviously, someone's going to build it for you. So there are advantages to having a house that's already in existence. Typically, it's less expensive than buying a house. There's a lot of extra costs in buying a house. And it also takes less time. Once you find a house and you get an offer accepted, it can be between 4 weeks and 8 weeks to go to closing. Whereas if you're building a house, Sarah, want to hit the next thing? If you're building a house, the advantage is you get exactly what you want. Sometimes builders have floor plans that are flexible where you can, add on a sunroom or add on an extra room above the garage, or make it a, 2-car garage, or make that 2-car garage into a family room. So there's a lot of flexibility for some builders, which is a great thing. The big downside is it takes an enormous amount of time to build a house. So people, I think, underestimate that. And honestly, I think builders kind of lead you to believe that it's quicker than it really is. It can take anywhere between 6 months and 1.5 years to build a house. So if you're willing to wait that long, that's great, because you get exactly what you want. You sometimes can pick out your cabinets and your countertops and your flooring. So you get it personalized just the way you like it. Although there's added costs for all of those things typically. But the big downside, especially in the market that we're in, is that the interest rate's going up. If you're waiting for your house to be built, you can't lock into an interest rate sometimes. So that can be a little bit of a frustration. I forgot to mention, if you guys can wait and for your questions at the end, Sarah and I will be here at the end to answer all your questions. Someone asked a question in the chat.
Oh.
So I forgot to mention at the beginning. I think we're ready for the next slide.
Okay.
All right. So once you find a house that you like, you love, and you want to make an offer, the agent writes your offer. Now, the offers are a standard form that in Pennsylvania, the national or the state realtors have created the form. You have to fill in certain information. So even though it's a standard, we call that boilerplate contract, there is information that you can add to it or change to make your offer different. So first thing people always think of when you're making an offer is how much. Price of the house is obviously important, but there's more than just price that goes into making an offer. Contingencies are terms of the contract that basically say they have to be finalized or agreed to before the contract can be done, can be completed. Things like inspections. A buyer can ask the seller to do inspections and make that a contingency, meaning that the buyer won't agree to buy the house until they've had an inspection and they're okay with all of the conditions in the house. If you get a mortgage, there's usually a contingency on having that mortgage approved. Appraisals, Sarah's going to talk about appraisals in a minute. So you can't really waive appraisals. That's something the mortgage company can do. But as a buyer, you could, if you wanted to, offer what we call an appraisal, paying for an appraisal gap, meaning if you offer a certain amount for your house, but it appraises for a lower amount, you're willing to pay that difference in cash. So you'll still get your mortgage for the appraised amount, but you're willing to pay that difference so the seller is not going to be out that money. That makes your offer much more desirable to the seller. Assists, which Sarah mentioned, is a way for buyers to ask the sellers to help them pay for closing costs. In this current market, that's not done very often unless there's a big problem with the house and the seller's having a hard time selling it. In other markets, that's been a pretty common thing that makes your offer less desirable if you're asking for the seller to help pay for those closing costs. And the last thing on that list under contingencies is something called inclusions. And inclusions are personal property that's typically sold with the house. Things like appliances, washer, dryers, refrigerators aren't automatically sold with the house. So that's listed as an inclusion. But those are things you can put in the offer that makes it either better or worse than another offer. And we're going to talk about the fact that right now it's a very, very competitive market, and that drafting an offer that's the strongest offer you can make is really important to winning a bid and being able to buy the house you want. Okay, next slide. Your agent will be able to help you with all those things. Preparing your house for closing. So home inspections, we talked about a little bit about this. If you there in this competitive market, there are buyers that waive home inspections. It's not something that I personally recommend because a house has lots of issues with it. There is no perfect house, not even a brand new house is perfect, but it's really good to know what's going on with your house when you buy it. So having a home inspection, in my opinion, is a very important thing in buying a house. But some people will ask for an inspection, and basically say, I'm not going to negotiate on that inspection. I'm not going to ask the seller to make repairs. I just want to know if there's anything big and scary. And the purpose of the home inspection is if there's things that are big and scary, we call them hidden problems that the home buyer was unaware of when they made the offer. They have the ability to get out of that contract without losing money. They get their deposit back, and they get to go on their merry way, and the seller can try to sell that house to somebody else. In this current competitive market, sometimes people are asking for inspections for just information purposes, not for negotiation purposes, not to, in prior markets, you'd have someone who made a certain offer on a house, and then based on the home inspection, they would try to negotiate it down, saying, well, there's all these problems with the house, I don't want to pay you as much for it. So that's kind of not happening currently in this market, but home inspection is a very important part of making an offer on the house.
Okay. So I'm going to talk a little bit about appraisal. So first of all, I always like to talk a little bit about the difference between a home inspection and an appraisal. So a home inspection is going to happen in the first couple of days after you go under contract for the house. And it's really like a report card for the house. So it's a licensed person that comes into your home, comes into the home you're going to buy, and they're going to nitpick every single thing that's going on with that house. They're going to gauge how old they think the roof is. How much life is left on the HVAC system. Not only that, but if there's loose outlet covers, if there is, chipping paint, if there's, anything that's going on with the house, even big or small, that's the report card for the house that tells you those things. And they're going to hand that report to you on that day when you go to get that home inspection. How that's different from the appraisal, and there's all kinds of different home inspections you can get. The basic home inspection is about $400. There's also all kinds of other inspections. There are termite, radon, stucco. You could spend up to $1,800 on different types of inspections. And really what Ann will do is help to guide you as far as what inspections you might want to get or not get. That is part of her job too. Like if they just got a new roof 2 years ago, you probably don't need to get a special roof inspection. Or if they don't have stucco, obviously you don't need a stucco inspection, right? So she's going to help talk you through all of that. The appraisal and how that's different is the appraiser's job is not to tell you everything that is going on with the house. Their main job is to give the house a value. And so how they do that is, again, it's somebody that's going to come to the house, the same house. And really they're going to take the square footage. They're going to take the age of the property, the school district, all of these different things into account. And then they're going to look at homes that are like your house that have sold within the last, hopefully 6 months or so. And those are called comparable sales. So their report is going to have your house on a little column, and then it's going to have like 6 other houses that are in the same neighborhood that are sort of like your house. And then they're going to give adjustments to that up and down to try to verify what we're saying, what they're giving as the overall value of your house. Okay. Now the appraisal of us as the mortgage company or any mortgage company is not going to require that you get a home inspection. Okay. If you get one, if you don't get one, we don't care. We do care if you get an appraisal, you have to get one unless we tell you that you don't need one. So with the appraisal, that is the bank, the lender that's lending you the money. That is the collateral. The house is the collateral. And that's what they want to make sure that house is in decent shape for them to be able to lend money on it. Okay. And so then that's why they say if the house does not hit value, if we don't hit the value of the house, we're only going to lend based on what the appraiser is saying that value is, which is why Ann was talking about covering that appraisal gap. The other piece of the appraisal is if there's something major going on at the house, then the appraiser may cite that on there. Let's say that there's mold, there's evidence of mold, okay, in the basement of the house. And it's very evident, like you could see it on the walls or something. At the bottom of your appraisal, then it may say this appraised value is subject to the following repairs. Okay. If there's anything that says subject to these repairs, what that means is whatever they say those repairs are, that needs to be taken care of before you can settle on the house or before the lender is going to be willing to lend you money. Okay. So it has to happen before you can settle. So what happens is sometimes if there's stuff like that going on, it might extend your settlement. If we need time to get those repairs completed, you may have to have the appraiser go back out to the house to show that those things were done. But usually I'm talking about like, these are major things. These are like things that are keeping the house from being, safe to live in, like mold, or specifically like for FHA is a little more strict with appraisal. So that's one of the differences between a conventional and an FHA or government loan. FHA is going to call out chipping and peeling paint. They see that as a hazard where a conventional loan would not. Now, chipping and peeling paint is not a big deal. It's a couple $100. You get somebody out there to sand and paint, and then you're good to go, right? But if there's like other larger things going on, it's just important to know that if it's cited on the appraisal, that means you got to get it fixed, whether the buyer or the seller fixes it, but it has to be fixed before the lender is going to loan you the money for the house. All right. So that's the difference between inspection and appraisal. I'm so sorry. Sorry about that. Okay. And then there's the underwriting and mortgage conditions. So what happens is, when we're in the loan process, we're going to get documents and we're going to get your application signed. And then we take your file and we put it into underwriting. Underwriting is where the final decision gets made on your loan approval. So we're going to ask you for stuff. We put it all in, and then the underwriter is going to come back and say, okay, your loan's approved, but we have questions, or we need, 3 or 4 more things from the buyer to make sure we're good on this loan. So through the loan process, it's kind of a back and forth with underwriting and the buyers or the borrowers to make sure that the bank has everything that they need to 100% approve the loan, which usually, that happens a week or 2 before your settlement. It's usually some back and forth because as we get more documents and as the lender gets more information, it prompts sometimes them to ask for more things. So it's kind of a back and forth. So what my job is to make sure that those things are happening in a timely way so that we can still hit your settlement date, whatever that might be. All right.
Okay, so we're going to actually.
Okay. So when you're getting ready for
sorry.
closing, is this yours? I'm sorry. Was this
yours
or mine?
We're almost at 7:30, so we need to go a little bit faster.
Okay,
so,
go ahead.
I'd like to talk. We do. So you go ahead.
Yeah. Okay, so the closing disclosure is a final settlement sheet. It's going to come to you. It has to be signed 3 days before your settlement. It does have a summary of your final costs. We have to have that signed 3 days before. If it's not signed at the right time, then we might have to push your settlement. That doesn't happen on my watch, but
not. And then right before settlement, we also do a final walkthrough. That's where your agent will walk through the house to make sure there's nothing major changed in the house. The roof isn't leaking. There's no holes in the wall. That the house is in the condition you made the offer in, and that things that are supposed to be in the house, like your appliances are there. It's in the condition that you expected. And then we can go to the next slide. I went fast on this one.
Okay.
And the next one is the actual closing. You'll have arranged, we have to bring your ID with you so we know who's buying the house. In terms of final payments, your final down payment and closing costs, that you will know ahead of time how much it's going to be. You'll also know whether you need to bring a cashier's check or you're going to wire the money electronically. You'll know that ahead of time. That won't be a surprise. You'll do that either electronic wire the day before or bring a cashier check the day of. Most buyers sign their own documents. There's a lot of documents to sign. You'll be walked through all of them with your mortgage professional or the title person, depending on who's doing your settlement. If you're unable to be present, you can hire or you can appoint someone to be power of attorney signed for you. And usually, it used to be the buyers and sellers were at the closing together. During the pandemic, we separated you and the sellers signed their documents separately. Now we're seeing it together again. So who attends depends on who wants to attend these days. We're almost done. Brief market update because we talked a lot. The market is very fast right now. It's a seller's market, meaning it's better for the sellers than it is for the buyers because the prices have gone up because of the demand supply inequity. But right now we've seen more houses hitting the market and we're seeing fewer buyers. I think some people got discouraged. So I've been calling my clients, telling them to get back in the market. So it's not a bad time to start looking now. And Sarah's going to talk about the market currently as well.
Yeah. So where are we seeing as far as, I deal with interest rates all day long, right? So with what's been going on with just a little bit of like the actual market. So the unemployment rate is where I've been at the all-time lows for unemployment rate. The unemployment rate is starting just now to tick up just a little bit. So historically what we've seen, and we all know inflation's been going crazy as well, right? So when inflation goes crazy, typically what happens is the Federal Reserve will then hike interest rates, which usually means mortgage rates go down when they do that. So they have started trying to combat inflation by hiking the Fed rate. We are in the last couple of weeks starting to see a little bit of a decline. We were at like 5.5. Now we're down around 5.25. So they're coming back down just a little bit. What this also means though, historically, is that we're likely heading into a recession. And while that's not great for the stock market, for mortgage bonds, it can be a good thing. So it can mean that we may see rates coming back down again, probably not through the end of this year. They're probably still going to either stay steady or possibly tick up a little bit through the end of this year, but in the first quarter of next year, we are feeling hopeful that probably interest rate for mortgages are going to come back down again in the first and second quarter of next year. And so what we're talking to our buyers about right now, because when you want to buy a house and you're ready to buy a house, no matter what the interest rates are, typically we find that people are going to do that, right? So if the rates are higher right now, we are trying to, we're offering incentives to, if you come back when the market is at a point to refinance, we'll do it with no lender fees and a break on the title once that point comes, because there's nothing we can do about rates right now, but we are foreseeing that they might get a little bit better down the road. So hopefully we'll be able to save you on some of those costs when that time comes. So that's the market update. And then we're done. We just have questions.
So we have some questions that were in the chat, which I'm going to read, and some of them are more to you, Sarah. Did I freeze? Okay. The first question was, do you have to hold 2 mortgages when you're building a house? Did I freeze?
I'm sorry, I missed it.
No, you're good.
Okay. The question was, do you have to hold 2 mortgages if you're building a house? And I don't think that's...
So if you're selling a house,
building
and then
a
buying
house.
a house, is that what it means?
I'm not sure.
Building a house. When you're building a house, do you have to hold, if you own a house, do you have to hold that house?
Yes.
While you're building? Yes.
Yes. So
well, unless you want to move somewhere else while you're waiting for your house to be built. So yes, if you're trying, and we're seeing this right now, people that are trying to sell and buy at the same time. What we're seeing happen often is they make an offer non-contingent on their home sale. And in that case, if you're not contingent on your home sale, then you would have to be able to hold both mortgages at the same time. Like your debt to income ratio has to withstand holding both of those mortgages. And also it means that you'd have to have enough reserves of assets to be able to buy the house without the proceeds from the home sale. Now, what we're seeing a lot of time in this market is homes are selling so quick that, someone might make an offer non-contingent on their home sale to be able to get the house. And then they put their house on the market right away. It sells in 2 days and they end up just using the proceeds from their home sale anyway to do that. Right. So that is what we're seeing, I would say a lot of the time, that's what people are doing right now because they're confident that their house is going to sell quickly. It's not like they're
ready while they're looking at other houses. That's
right.
what we're
The risk of having to have both of those mortgages at the same time is not high right now.
Yeah.
So I asked that because a lot of people have this dream of building a home, and I don't think they understand that part.
So when I have a client who's building a home and they're renting right now, they had to put a certain amount of money down as a down payment, which is a big chunk. The rest of that loan is not due until their house is ready. So they don't have to have that loan until basically the builder takes on that cost. And once the house is done and they go to closing, then they take the mortgage. So they're not holding a second, they're not doing a mortgage until they actually own the house.
Okay, can I jump in right quick, guys? I just want to say thank you to everybody for coming tonight. It is 7:34. So as usual, our parent information nights always go over Ann and Sarah because our parents are so engaged and they hang on. So, but I don't want anyone to feel guilty if you have little ones or dinner or something you need to get to. So we're going to officially close it out, and I'm going to keep the recording going for anyone who wants to stay. But don't feel guilty if you need to go.
And we also have some contact information if people want to reach out to us to ask us specific questions that they want to ask in the chat or in this question.
So I usually send out a thank you note afterwards, and I can put that information in there for
That'd be wonderful. Thank
registered. Even if they didn't attend, if they registered, we'll send it to them.
That is wonderful. Thank you, everybody.
There is one thing I did not talk about that I didn't actually talk about the actual pre-approval letter that you get. So the pre-approval letter is what you would need to make an offer on a house. You have to have that. In the market that we're in, a lot of real estate agents are requiring that you have the pre-approval letter before you even go to see houses, because they want to know that you actually can buy the house, not what the agents like to call kicking tires. So they want to know that you actually are serious and want to do that. So when you get the pre-approval letter, it's good for about 4 months, which is as long as your credit report is valid for. Now, personally, I'm not going to keep pulling your credit every 4 months, especially not without asking you that question. If you have very good credit, what I might do after the 4 months or, throughout the process is, are you still at the same job? Do you still have X amount of money saved? If so, your credit's very good. I'm just going to reissue your pre-approval letter. We'll pull your credit again once you find the right house. If your credit is marginal, like if it's like that we're not sure if you're going to qualify level with the credit, then I would pull your credit again just to make sure you're still good and qualified to buy on there.
So I'm going to read a couple of the questions that are in the chat, and then people can ask questions. Is that okay? So one person asked a question about trying to buy a home without savings. My suggestion is to talk to a mortgage person to see if what you have is enough. Like Sarah talked about the fact that what closing costs are and down payment, but some of the down payments can be pretty minimal, a lot less than people thought. So don't assume you can't afford a house until you talk to a mortgage professional, because that I think is really helpful. Another question is, good question. Can I ask for an inspection before making an offer? The answer is, in this market, probably not. Because it's so competitive. If it becomes a buyer's market where the buyers have the upper hand, then sometimes you can. But what happens is you make an offer and then you do the inspection afterwards. I know it seems a little bit backwards. And sometimes you'll have a situation where I was selling a house for a client and we did an inspection and gave it to everybody. So all the buyers knew what the inspection was before they made an offer. And I thought that was very helpful. Any other questions? 2 seconds. Sarah, this is a question for you. Can a fiance/boyfriend give monetary gifts towards buying a house?
Yes. If the fiance or boyfriend is going to live in the house, then the answer is yes. We have, this is a situation with gift funds that we have run into. So where you could not get a gift is if fiance's parents want to give you a gift and fiance is not on the loan, then that is not allowed, because technically the gift donor then is not related to the person that's on the loan. So it has to be, the relation for the gift funds has to be either the person that's living in the house with the person, or fiance, or boyfriend, or whatever it is that's going to live in the house, or it has to be a family member of the person who has the loan.
Okay, next question. If student loans are in good standing, can it still be difficult to get approved for a mortgage loan? And And there's some contact information questions.
So
So
there's rules around student loans. Even though if your student loans are deferred, because this is a good question, if your student loans are deferred and you're not currently paying on them, that's fine. However, we still have to count a payment. So for FHA and Freddie Mac, which is one of the conventional versions, it's a 0.5% of what the balance is that we would have to count as a payment. So if you have a $10,000 loan, then it would be a 0.5% of $10,000 is what we would have to use for the payment. If it's a conventional loan and you actually have a 0 payment and you can show us that your payment is 0, then we don't have to include a payment there. So it really just depends on your particular situation with your student loans and what that looks like. If you're on an income-based payment plan, we can use that as, that's what's going to report on your credit. We can use that lower income-based payment on your student loans. Where we have to put a payment in there is if they're deferred. If it says like unknown payment or no payment, then we have to use the 0.5%.
all the questions are for you, Sarah. Another person asked if you don't have any credit, how do you go about buying a home?
Okay. So my first advice would be to get some credit. Right. So because here's the thing, your credit score is a reflection of how well you can manage debt. Okay. It's a reflection of the activity of how well you've managed debt. And so if you have no history of managing any debt, then the bank is not going to want to lend you $200,000. Right. So
that's about credit cards, paying rent, paying a loan off of on a car. So there's lots of ways to build credit.
And if you're paying a cell phone bill or an electric bill or something like that, you can self-report your bills on your credit.
Yeah, if you're paying rent to your parents, you can also self-report bills.
Yep.
Can you? I think you can.
Yep. So all those things, you can call the credit bureaus and have them self-report some of those things if you're making those payments on time. We do have outside the box loans, we have like non-traditional credit, which means like, okay, we can get a verification of your rent, we can get cell phone bills, we can use other things. But there's those types of loans are so costly because the interest rate is super high on those outside of the box type of loans. So you're going to be talking about an 8, 9, 10% interest rate to try to get one of those non-traditional credit loans, where if you just get a couple credit cards and wait 4 to 6 months, you could have a 5 or 4.5 or 5% interest rate. So I would say get 1 or 2 credit cards, keep the balances low on those credit cards under 30% of the limit on the card, and wait a couple months, and then you'll have a score generate.
Next question. Again, they're all for you. Can a person with a credit of 560 credit get approved for a mortgage?
Okay, so the minimum score typically to get an approval for a mortgage is 580. But again, that's not a guarantee. Like if your score is 580, it doesn't mean you'll definitely be approved. So you're looking at an overview of the credit, the income, and the assets, right? So if you have a 580 credit score or, between 580 and 600 credit score, we may not get an approval for you if your debt to income ratio is very high, or if you don't have a lot of money in savings. So if it's all 3 of those things that are being looked at to qualify for the loan. Typically we're not, if 580 kind of is the bottom of where we would get an approval for a loan. Mm-hmm.
But there are ways to improve that you can talk about with someone one-on-one to improve their credit score, correct?
Yeah, absolutely.
Things you can do to sort of repair your credit score. Next question, also for you, Sarah. If a large cash deposit was made into the account 4 to 6 months ago, do those funds still need to be verified to be used for a down payment?
We're going to look at the last 2 months of your bank statements. If we see the funds being deposited into your bank account, we're going to question where it came from. If we don't see the funds deposited in your bank account and they're just in there, we're not going to ask, is my answer to that.
Already there. Next question. Can a foreclosure on your credit still get you a home? Basically, can you buy a home if you had a foreclosure?
There are time limits. So depending on for foreclosure, there's all different. So foreclosure, short sale, Chapter 7, Chapter 13 bankruptcies, all of these things have time limits that you have to wait before you can apply for a mortgage. Some are more forgiving than others. So with a foreclosure, typically they want 7 years after the new person bought the house from your foreclosure. For a short sale, depending on, again, the type of loan, it's anywhere between 2 years for FHA to 4 years for conventional. So it just kind of depends on the situation there.
And that's all the questions we have in the chat. Does anyone have any other questions? Oh, I have one more, just a second. So someone's asking, their husband has no credit and they don't have good credit. So the question is, how should he apply for the mortgage? Again, we talked about the fact that he needs to establish credit, and that can be a 4 to 6 month process to get credit in his name. And then you can also take steps to improve your credit so that's helpful. Is there anything else on that category? Okay. So wonderful. Thank you all so much. Again, if you have more specific questions that you don't want to ask in a general way, you can contact either me or Sarah. Our contact information is there. And thank you so much for joining us today.
Thank you guys very much.
Thank you, Ann and Sarah. This was so helpful. My superintendent was texting me saying, this is great information. This is awesome information.
Fountain of knowledge. She really, truly is. And she's awesome.
So good. Both of you, the whole process it can be very scary for a lot of people. And what I like is that you were hopeful, because a lot of people think that their situation is hopeless. And Sarah and Ann were like, don't give up, try first, let a professional tell you it's hopeless, and then they will give you the path forward.
There's always
knowledge is power. So, it's finding out where you are is the first step to figuring out, okay, well, what's the next step to try to reach those goals, right? I mean, I have people that have been looking, and Ann, I'm sure, has people that have been looking for a year or two, or just, it's us like sending little reminders. How's everything going with your credit? Just like poking and reminding people like, all right, you're going to save X amount of dollars in the next couple of months or whatever. It's a marathon, not a sprint sometimes, you know? Mm-hmm.
It is. And you have to have an agent who's patient and a broker who's patient. That's very helpful. Yes. There's always hope.
So thank you, parents, for coming out. We have 2 more parent information nights. One is from Lakeside Neurologic. That's on the 31st. And the topic is, hold on, let me get that. It is moving from problem behaviors to problem solving. And then we have our last one, which will be on June 6th. And this is going to be facilitated by Dr. Ron McGinn. And this one is called Sustainable Parenting, Realistic Self-Care for Parents. So we are trying to give you guys like practical stuff, that parents need, because we know if our parents are strong, then you're going to take care of our babies. So we want to take care of you first. You're the foundation to the households, and we want our families healthy. So look out for those registration links. They will be in your parent information. In your Wednesday folders. It's across all of our social media. It's on the website. Make sure you register. And as I started off saying before, you guys are the best form of communication and marketing for us. Parents, please tell your neighbor, the district is not playing. We are giving you great stuff. It's good stuff. So tell them to join in and into the conversations, and you always have an opportunity to interact with our facilitators. It's never just a telling, you get a chance to go back and forth. And thankfully, Ann and Sarah are just open to it and giving us extra time. We appreciate it. So with that, Ann and Sarah, if you guys don't have anything further, we're going to go ahead and say goodnight.
All right. Thank you guys very much. Have a good evening.